All right. Looks like I'm live. Somebody out there, let me know if you can hear me. Let me know if everything is working. Let me see here. All right. So you guys are about to get my live reaction to the market. I am literally just waking up from my, let's call it mid-morning, mid-afternoon nap here. But yeah, I'm gonna bring up well crap. Yep, it's another bad one today. All right. Let's talk about that. And I kind of suspected that when I went to sleep earlier today, it was going to be bad. I just didn't realize the Nasdaq was going to be down 525 points by the time I woke back up. But yeah, let's talk about investing. I'm sure you guys are worried about what's going on right now. And if you notice, I never seem too worried about what's going on right now, although I do feel a little bit more pressure than I do normally. But let's talk about a few things out there. How many of you guys have a lot on margin right now? That's really the question you want to ask yourselves. If you don't have a lot borrowed or of money out there that's borrowed right now in your portfolio, you don't have a lot on margin, then your response to what's going on right now might be no response at all, right? If you haven't borrowed a lot of money to get into the positions you're getting into, then maybe you don't need to do anything at all. But a lot of you folks out there are probably looking at the market right now. You're sitting on, 25, 30% of your account being borrowed money, and you're wondering when that margin call is going to come. So let's talk about what your responses are right now, what positions you're going to look for at this point to sell, and which positions you're going to look to keep at this point. So, unfortunately, when you get caught behind the eight ball like this, some of the positions that you want to take a look at selling are your most volatile ones. The most volatile positions for a lot of people are oftentimes the ones that they have the most faith in, and faith is very dangerous in this case, right? Those are the ones you think are going to make the hardest comeback. Those are the ones you think are going to be the best stocks here in the future. But a lot of times, the ones you want to keep in your portfolio, in the case of a margin call, when you get to pick and choose which ones you're going to sell, they're going to be your most boring stocks. Those are going to be the ones that you want to sell. And let me talk about why that is. That is because when there's the opportunity to get back into those stocks, likely down the road, they're going to be pretty close to the same price where you had to bail on them before. The volatile stocks that you have right now, if you bail out of those stocks, there's a good chance you might pick them up lower down the road. There's a good chance, though, if you are correct, and it is something really great and it's something that really takes off, that you might get caught behind on that. You're never able to buy back in at the same price, and you get left behind here. So this is kind of the thing that I'm worried about right now. Like, I'm not in danger of having a margin call right now, but I know I've talked to a couple people who are at this point, and they're saying, which stocks should I sell, which ones should I keep? Honestly, that's one of the harder questions I've had to answer in my career so far, just because there's a lot less certainty about what's going to happen here in the future. And we can talk about anything you guys want to talk about, start firing away on the questions here. Like I said, I just looked at the market. I see that Tesla is down to 785. In most cases, that looks like a very good buying opportunity to me, down 10% today. The market is down pretty hard as well. But some big surprises out there, like Unity Software is down 12%. It's $50 a share right now. Even some stalwarts like Morgan Stanley has fallen pretty significantly over the last 2 or 3 months. Goldman Sachs has fallen by, almost $100 per share over the last couple of months as well. A company that I've held that I haven't really talked about too much, Big Bear AI Holdings, that has fallen by 17% today. And yeah, so Twitter is also down by 3.65% today, which is well below it. Now it's well below the tender offer price of, I think, $54 per share. A couple of other things are looking pretty good right now. Upstart Holdings. Upstart is involved in lending, of course. That is something that's looking pretty good. Nvidia, somebody in my Patreon group a few months ago predicted that Nvidia could go down to $150 a share. Uh, I'll be honest with you, that is not a prediction that I took very seriously at the time. But if you look at the price today at $169.65, that's looking a heck of a lot more likely at this point. If I had to have one stock that I would say go ahead and buy today, because it's an opportunity and it should be a core portion of your portfolio then we are probably looking at NVIDIA here. That would be the best opportunity today to purchase is NVIDIA. Other opportunities out there, of course, Amazon, down very significantly, almost down $1,500 a share from its peak. It's at $2,175.59. And we are still looking at a split here in the future. Some other things that you may not be thinking about, like Taiwan Semiconductor Manufacturing Company, they're opening up a facility here in Arizona pretty soon. I actually know someone who's going to be working on that project in an indirect manner, but they're down also by 4.71%. So look, everyone's down across the board here. You're not going to find a lot of specific news about any company out there about why that particular company is down. This is very generalized right here. It's based on fears of the unknown and the fear, of course, that the Fed put will not work this time, meaning that the actions of the Federal Reserve may not be enough to rescue the economy from inflation. And we talked about that. I did a long soliloquy on inflation during my last live stream, and I talked about that. And let me talk about the folks that are concerned about the Fed put, meaning the Fed's ability to control inflation simply by raising interest rates and using other tools. You are correct in that it's not going to have an immediate effect on inflation. The one solution to this that no one wants to hear is that this is simply going to take time. There is not a government policy that caused this. Maybe you could say there's a series of government policies that cause this, but nothing that has happened even in the last 2 years. You can't point to one thing and say this is causing this. You can't say it's just energy. You can't say it's just supply chain snarling here, but supply shock in general is probably the biggest cause of this. And I went through all of the examples during the last 5 periods of inflation where it was supply shock for the most part that caused this, and then exacerbated by oil later on down the road. So, let's talk about a few things going on right now. Epic Hamster, frequent member of my live chats and live streams rather, and also a member of my Patreon, saying I was super happy to get NVIDIA at 200. Wow, I picked up a few shares at 200. I remember buying it at like 225, and I was happy to have it at 225. I would be much happier if I bought it today at $169 a share. And NVIDIA is one of those companies where I've never been able to buy as much as I wanted to when I wanted to. The timing simply hasn't worked out. So I've dollar cost averaged my way into my position, but I'd love to have a lot more. It wasn't like Tesla, where I got in really, really early and was able to buy a lot for very little, or a couple of other companies like that. Frantic Pillow says, any recommendations on what to do, DCA or wait? DCA stands for dollar cost average in this case. I definitely recommend dollar cost averaging. I don't know if I would wait. If you have cash on the sidelines, I don't know if I'd wait. If you have a lot of money on margin, you're probably thinking about something different right now, which is reducing the amount of money that you have out there to reduce the chances of a margin call. But if you have cash, dollar cost averaging is definitely the way to go. I don't think, and I think it's pretty obvious right now, that this period of volatility is not finished. Not by any stretch of the imagination is it finished, and it's going to continue for several months to come. There's just, like I said, we need time to work ourselves out of this situation. Michael will also, let me remind you guys, super chat features are on if you guys feel so inclined. I'm always very happy to see your generosity here. Michael Will says, I've seen opinions saying that the S&P will go around to 3,800. So I am, I tend to make predictions on here more than I would like to make predictions on here, because time, Mother Nature, and random chance tends to make a fool out of you the more predictions you make. I will say, however, that the S&P going down to around 3,800 is certainly within the realm of possibility. In fact, I was just on a meeting this morning at 9:30 where they think the research done by this company says that they think that's kind of where the floor, or at least a support level for the S&P 500 is. Meaning if it busts through that and stays through that for a while, there might be a new floor. But the S&P right now is at 39.91, so it's pretty close to that bottom at this point. Patrick Mulligan says Unity Software, yes. So Unity Software, and I'm very curious about Unity Software and about Roblox here. So Roblox, I think, is reporting earnings this week. And at their last earnings report, they had a lot to say about user engagement and how the user engagement's acceleration was slowing a little bit. And meaning it was still growing, but that growth acceleration had slowed down a little bit. And they predicted that by the middle of the year, that was going to turn around. Okay. So I'm thinking that we're going to see some indication of that, whether or not that is true with this report, and that's going to give us an indication as to where Roblox is going to go. I think that there's just not enough information on Roblox right now. It's been growing, but that growth has been slowing a little bit. I noted that in the video that I made on that recently, but I think we're going to have a better idea coming up here pretty soon. But there's a lot of companies out there, growth companies, that aren't profitable right now, that have a lot of cash on hand. And yeah, so they have a lot of cash on hand, and they're going to look like good buying opportunities here in the future here. So, Jason, Hyliion is now under $3, far less than cash on hand. Crazy times. Yeah, I haven't looked at Hyliion for a while. That's one of those companies where I did a video on it. I thought about buying it, but I never pulled the trigger on buying that on Hyliion. I'm glad I didn't, because I would have purchased it on speculation, probably at a higher price. But then again, you guys know that my time horizon on these things is extremely long, meaning my buy a stock, I'm probably going to hold it for years and years and years. And I tend to hold it through really long periods of volatility and not really think about things very much. Like I've got, 100 shares in Morgan Stanley, 100 shares in Goldman Sachs, and I never think about those. I never even look at those at the prices. They're in one of my accounts with some of the other things that I look at a little bit more often. But it's one of those core positions that once I purchased it, I don't really think about it. Hyliion probably would have been one of those had I purchased that, and it's something that I would definitely notice was down by 80%. So I have gotten absolutely crushed on Roblox here. My average price across my accounts that I own in then is probably close to $60 a share. It is down to $24.61 at this point. I've gotten absolutely crushed on it. Bruce says, Upstart, goodbye. Not sure what you mean by goodbye. Upstart's a profitable company that has been growing profits for years. They're going to benefit not right away, but they're going to benefit pretty greatly from increased lending rates. And it remains to be seen whether or not their loan portfolio is actually going to survive the test. I don't know if you guys, I talked about this a little bit before, like you remember prosper.com, and they're just called Prosper now, but they were a micro lending platform and they let you build your own portfolios. One of my worries is that for them is portfolio quality. Like how high quality are the loans that they've made out there, and what is going to happen if we see a loss in unemployment. Right now, we're not seeing a loss in employment. Unemployment numbers are still really, really low. The economy is adding jobs really quickly, and we're still seeing wage growth, right? So those are good signs about the economy, and consumer activity is still pretty strong too. It's just we can already see shifts in the way people are spending money, and they're becoming choosier about the way they spend it. And of course, people are being forced to spend more money on food and on fuel. Okay, so what do you think about the commercial mortgage-backed securities bomb theory and Evergrande? So I'm not sure you and I read the same article on this, but I will say one thing is that there is an issue right now with Evergrande. I don't think that you and I are on the same page with this, Chris. Let's talk about this offline here. Check the after hours Upstart. Yeah, let's take a look at that. All right, so check. Holy crap! Oh my gosh. This is amazing. All right. This is amazing. Okay, hold on. Let's check this. All right. Let me share my screen. All right. I'm going to share my screen here. Upstart after hours. Can you guys see my screen? Upstart after hours. down $27.24, down 34%, 35%. Already, it was down 8% during the day. And it's because of first quarter results. Let's take a look at that. Let's take a look at what's going on here. All right. So Upstart Holdings Inc., leading, okay, blah, blah, blah. First quarter highlights. Total revenue was $310 million, an increase of 156%. Total fee revenue was $314 million, increase of 170% year over year. Bank partners originated 465,000 loans, 4.5 billion across the platform for a quarter, up 174% for the same quarter. Conversion on rate requests, okay, that's a concern. It was 21% on first quarter of 22, down 22% the same quarter before. That's an indication of trouble there. Conversion on rate requests. We see here income from operations was up 34.8 million, up from 15.6 million. GAAP net income was up 32.7 million, up from 10.1 million first quarter of 2021, and adjusted net income was 58.6 million, up from 19.9 million in the same quarter of the prior year. Accordingly, GAAP diluted earnings per share was 34 cents, and adjusted earnings per share was 61 cents based on the weighted average common shares outstanding during the same period. So, okay, let's see here. Where's the terribly bad news here? Where's the terribly bad news? Upstart has not reconciled forward-looking GAAP measures above to comparable forward-looking GAAP measures because of the potential variability. Okay, it's about forward guidance at this point. They're not providing a lot of forward guidance here. So in terms of their actual first quarter results, it's not terrible at all. In fact, it's really good. In terms of guidance, it doesn't look like they're providing a ton of guidance here. There's probably something going on in the actual call too that we don't know about. So it looks like there's a call going on right now. Yeah. The US economy seems so strong. China and Europe, on the other hand. So, yeah, so if you're looking at the economy, it seems strong enough. Certainly no worse than in other time periods. If you're looking at the stock market, it looks absolutely terrible right now. But let's remember, what is the stock market? The stock market is a pricing mechanism for forward-looking observations on the health of the economy, meaning the stock market is looking months and months and months down the road, right? Generally, the accepted period is anywhere from 6 to 9 months down the road. And I would say that right now, the stock market is pricing in economic troubles over the next 6 to 9 months. Yeah, and so I would definitely say that the economy is probably stronger. The economy is probably stronger than people think it is. The stock market is not, and the stock market is not the economy. And remember, the recovery comes lightning quick, and it comes well before the economy itself actually recovers. And that's been in evidence in every single economic downturn. The stock market begins to recover before the economy does, because the stock market is a forward-looking pricing mechanism. The best example of that was the economic crisis of 2008, 2009. If you'd have asked someone in 2012 how they thought the economy was, they probably still would have said that it was pretty bad or even terrible. But the reality was the bottom of that market was, I think, March 24th of 2009. And by April, the market had gone up by like 40%, and something close to those numbers. And folks just who weren't in the market every day, weren't in the business every day, they just simply didn't realize that. And the perception was that the stock market was still doing terribly, when that was far from the truth. The stock market recovers well before the actual economy does. So let me see here. And SOFI 10x at this level. I think eventually, yes, SOFI is going to 10x at this level. That's another stock that I'm getting crushed on at this point. My average cost on them is, I think, around $16 a share now, and they were under $5 or under $6 a share earlier today. I don't know where they are now. Let's take a look at SOFI. And you guys are going to see my live reaction to this too. SOFI Technologies. And it's down another 46 cents after hours, 7.71%. Getting crushed on that as well. And at this point, I've got more than 7,000 shares of this stock. So, yeah, I'm absolutely getting crushed on this too. Look how worried I am, though. Why am I so unworried? A lot of it is the long-term horizon that I have. I'm not happy about this by any means, guys. I don't want to be down for the next 9 to 12 months, but I've been investing long enough to realize that it's going to happen. It's going to happen a lot for the rest of my life. So, Claire says, "Are you still a big believer in Algorand and crypto in general?" So I'm a big believer in crypto in general. Crypto. So the United States, or at least the Western world, for a long time has lacked a sort of extra monetary system for transfer of value for a long time. Like that's been available in Asia and the Middle East and in North Africa for a long time. Something called the Hawala system. And it's been used because of transitory populations as a way to transfer value, right? Basically, crypto has become the new way of doing this, and so I do think so. Any particular currency, though, whether or not I am a big believer in those, I am less a believer in any one single currency right now, simply because how good a cryptocurrency is and how much it's adopted by different applications doesn't say a lot about how much is used by the general public, and it doesn't say very much about tokenomics. How is it going to grow at that point? So, yes, I do think that crypto is going to be around for a while. I think that like I said, it's here to stay because it's a new way to store and transfer value from one location to another in private in a lot of ways. I mean, it's all, of course, blockchain is all public, but it's a way that can't be censored by the government. It's a way that can't be stopped at this point. Of course, they can prevent you from turning that back into local currency somewhere, but we're probably looking at, millions of Russian people looking to leave Russia at this point. Highly trained scientists, doctors, engineers who are going to be taking advantage of what I suspect is a new visa program in the United States to create a brain drain from those folks from Russia. And in the past, those folks came over here with almost nothing, right? Their government seized most of what they owned before they left. They were only allowed to leave with a certain amount of currency. That's all going to change. You're going to see a wave of immigrants coming here, highly trained immigrants coming here to the U.S., probably on a new H-1B visa plan targeting folks in Russia to create a brain drain there. And they're going to be coming with funds this time. And that's actually going to be good for the United States in the long run for our economy. They're going to be bringing a lot there. So Claire says, I'm getting crushed in SOFI. I bought at 1825. I'm getting crushed as well. Right. So there are one or two stocks here that I may end up selling in order to do what's called tax loss harvesting. And meaning I'll sell that stock. I'll stay out of that stock for 30 days or more, and then I'll probably jump back into that by early summer. And not necessarily as a way of timing the stock. I just don't think that there's going to be a ton of great news in the meantime. And I have made quite a bit of money in short-term gains this year, kind of by accident, and I'd like to offset some of that. So, and you can do that by doing a little tax loss harvesting now. Some of your more volatile stocks, like Unity, if I were to sell that today I think earlier I was thinking about selling like $55 a share or something like that. I don't think it's going to be back over, say, $60 a share by the time I, get back from from my vacation from the stock market in early June or mid June or something like that. I don't think it's going to change that much. Actually, it's at $50.50 right now after hours. And Pat Mulligan, my only green of the day is Clover Health, and I wonder why that is. So let's see. So everything got crushed in my portfolio today. Like I'm not looking at anything that's up in my portfolio. But you're looking at Clover Health Investments is up 48 cents after hours. That is up 19.92% after hours. That's actually pretty good for today. And so let me see here. Not seeing a ton of reason why that should be, unless they're having their earnings report due today as well. And I see a headline that says, okay, so they're set to release earnings on May 9th. So, and it says, don't buy Clover stock ahead of earnings. This is what the headline says. Today's May 9th. I guess earnings was pretty good if the stock is up 19% after hours. So, but let's remember it's 19% on a stock that was $2.41. Leo Wu says, "What's up, Jason?" Leo, I have not seen you in a while on live streams. So Leo says, "Any thoughts on Xpeng?" Xpeng. So Xpeng's performance as a company so far has been just about as good as I can expect it to be under the current challenging circumstances. The things that are affecting it right now are what's going on in China with all of the lockdowns. I think that it's not just China, but there's a lot of countries, a lot of authoritarian countries right now that are running the risk of social unrest. Uh, Russia has and China take different approaches to putting down social unrest in their countries. But China generally does it in a more intelligent manner, and I think they're going to come up with a solution right now that is in opposition to their zero COVID policy. It's economically damaging at this point. I don't know what that is, and I'm not trying to judge China for that. They don't have the healthcare capacity to deal with a major pandemic like this, and lockdowns really were in their best interest. And they don't have the healthcare coverage of professionals like we do in the Western world and in Singapore, in South Korea, and Japan. And any major outbreak of COVID would actually make them look a lot worse in comparison to those countries. And they're a much larger nation. They're like 1.2 billion people or something like that. So, but in terms of Xpeng in general, the fears of delisting are wildly overblown at this point. It could still happen. Don't get me wrong. But if you look at what's going on now with Neo, they've created several different avenues to because of the possibility of delisting. Meaning they're listed now on the Hong Kong exchange. They're listed domestically, and the Neo is actually listing on the Singapore exchange here in the next couple of weeks. So it is entirely possible for you to own shares, and I expect Neo or Xpeng to follow suit when it comes to that Singapore Singapore secondary offering. They're going to use that, number one, to raise cash, and they're going to use that to sort of mitigate the possibility. And every company that's threatened with this would do this as a matter of due diligence here. If we were a United States company, that was listed on the Chinese exchange, and there was a chance that you would get delisted from that Chinese exchange, then you would definitely have a secondary offering on the Hong Kong exchange as well, because you want to stay in capital markets, right? You want to be able to go out to bond markets and borrow money as well. So you want to stay in capital markets at least somewhere and have access to that country's investor base. So it's not surprising that they're doing this. But negotiations are ongoing, and from what I understand, negotiations are actually more serious and less contentious than headlines would make you believe they are. They're professional and they're ongoing, and they're just going to last for a while. So, I'm sorry, I don't. Let me see here. For some reason, my comments aren't coming up too well here. Sorry, I can't read Arabic anymore. I used to be able to read it a lot better. I can't do it anymore. But what about Neo and stock price? A lot of the same things I said about Xpeng. Let's remember that both of these companies are really small. They've gotten a lot of press here, and they're considered extremely important over here because of the media coverage. But in terms of the vehicles that they produce in China itself, they're not really top tier players in terms of volume. Like BYD, Hosan, and a couple of other companies are actually outproducing Xpeng, Neo, and Li Auto combined, right? Particularly BYD, and they're going to have more negotiating power and more connections when it comes to securing when it comes to securing their supply chain for different things. So it's not surprising that if there are supply chain issues that are generalized and everyone is having issues, that they're going to be affected the most because they already produced the least. That, to me, that's not surprising at all. We're even going to see that Tesla is being affected by this. So let's talk about Tesla. Them up real fast. And look, I am for a couple of reasons, I am not in favor of the idea of Tesla being bought by Elon Musk. And the big reason is because I don't think he needs any more distractions. This is basically, the stock was almost at $1,000, or a little bit over $1,000 per share when close to the time that he announced that he was going to buy Twitter, and it's gone down a lot since then, almost 20%, and a little bit more than 20% actually. And I think a lot of that has to do with feel like he's going to get distracted by this, and I think that distraction is already occurring. This is not a done deal by any means. He's not going to be able to go the traditional routes to do this buyout. He's going to have to go to basically friends and family to do it. He's already stated that his main goal is not to make money. So why would you loan someone $44 million or $44 billion to go out and buy a company when their aim is not to maximize profits? Okay. If he sees this as an investment in free speech, then it's not a investment for business, right? And I think he's not making a clear case here, like how he's going to make money on this. If that's, he's telling us, and that's a literal quote. He said, this is not some sort of way to make money. It's a way to protect free speech. Okay. If I buy that, it means that I probably wouldn't invest in this project. The business of business is business. It's to make money. And I'm not going to loan you, $7 billion out to make a part of that $44 billion if your intention is not to maximize profits, right? And a lot of folks are going to consider. So I think there's a really good chance that this deal falls through on lack of financing. If he were to finance it himself by borrowing against his shares of Tesla, right now his shares of Tesla are worth a lot less than they were 60 days ago, and interest rates are creeping up on margin, and they're going to get even higher. And in the event of a margin call where he has to liquidate some of his Tesla stock to cover that loan, he's looking at having less and less control over Tesla. So there's a lot of reasons why I think that this deal might be in trouble, and it's already a distraction. He's got a lot on his plate. I realize he's far more intelligent than I am. He's far more capable than I am, and probably anyone else who's watching this live stream. But let's face it, can you really run a space company, an electric vehicle manufacturer, where you're trying to really be a technology and energy company and provide energy storage solutions and change the world and decarbonize our economy? Can you really do Neuralink? Can you really do the Boring Company? Can you really do all of those and be the protector of free speech? For a secondary reason, I'm not sure that I'm comfortable with him owning the public square, right? And I do think that the idea of open sourcing the algorithm so everyone knows how the algorithm works for Twitter, I think that's a great idea. I think it's a fantastic idea. I also agree that it can't be done by the people that are currently in charge of Twitter. It can't be done, right? They are too politically compromised. I'm just not sure that the people that are getting together in this new group are going to be any less politically compromised to do that. So, yeah, I am. My biggest concern with the deal with Twitter is that it's distracting him from the areas that we've already invested in. I've already invested in Tesla. I've already invested in his vision for a decarbonized economy, or at least partially decarbonized economy, based on electric vehicles, based on energy storage solutions and all that. And I feel that the Twitter purchase is a giant distraction. So Michael Will says, I'd rather that Elon bought Albemarle for 30 to 35 billion. That would be even better for Tesla. That would be better for the planet if he did that, right? I think that one of the greatest things he could do as an individual for the planet is to buy a company like Albemarle to smooth out the kinks in the supply chain when it comes to the producing batteries, and move us along as quickly as possible to a battery powered transportation. And that's coming far faster than my original predictions were back 5-6 years ago, even 2 years ago. Like I can't even begin to express to you how shocking the amount of people driving Tesla. Like I pull up, this was on Balboa Avenue at the Ranch 99. If you guys don't know what Ranch 99 is, it's a Chinese grocery store it's in San Diego. I don't know if it's in other parts of the country, but I pulled up to a stop sign in a shopping center there on Balboa. Now this is not the wealthiest neighborhood in San Diego, but I pulled up and my kids noticed it before I did. At the other 3 points of that 4-way stop, there were 6 Teslas waiting to cross. 6 different Teslas. 3 of them were actually red Tesla Model 3s, right? And my kids are the ones that pointed this out. I didn't even notice that. It is stunning the amount of electric vehicles. And in that parking lot, there were electric vehicles that I didn't even recognize. My son was the one that was saying, hey, this is an electric car. Hey, this is one. My daughter too. And I didn't even recognize that these were electric vehicles. And so this is not a neighborhood that's poor by any means, but it's not a neighborhood that's extremely wealthy. It's not La Jolla, California. It's not, you don't have celebrities living there or anything like that. But I was absolutely stunned. And if you look at the demographic makeup of the people that live in this neighborhood as well, the fact that there is such a high concentration of electric vehicles there even surprised me. That really surprised me. So yes, I do think, Michael Will, that Elon buying Albemarle would have been a better investment for Tesla and a better investment for the planet, for humanity in general, than buying Twitter. So I think if people are really unhappy with Twitter and really unhappy with the way they control speech, then some other form of communication is going to arise. And that's happened. Have you guys paid attention to what's going on with TikTok? Now, I'm not happy with TikTok either. That is absolutely a censored platform. Absolutely a censored platform. You can use certain words in your videos and watch it essentially get pushed down in terms of how many people it gets out to. And TikTokers are pretty adept at figuring out which videos they are. In fact, they have their own language for talking about things like battlefield deaths and all that. They call that unaliving instead of killing, or casualties, and they even censor themselves when saying words like Putin or Russia, because they realize it's going to get pushed down by censors in terms of how many people it's served to. So, but there would be another platform that arose if people were that unhappy with it. That's how capitalism should work. And that's how it does work. We have other avenues. If you don't like Twitter, there are other avenues out there. And if you look, I don't use Twitter. I imagine that most people using this don't actually post to Twitter. They might have Twitter to like go through it and look at it, but just like TikTok or something like that, it's unnecessarily addictive, and I'm not on it that often just because it's unnecessarily addictive. Daniel Trost says, I just bought more NEO. Good for you, Daniel. And my entry point into NEO, I'm still pretty far away from my actual cost in NEO, meaning I could ride it down to I think it was like $1.80 per share, and I'm still pretty good on this. But dude, I'm not happy about the fact that it was once close to $68 a share, and now it's down to like $15 or $16 a share. Certainly not happy about that. Like I said, there, NEO's potential as a company has always been greater perceived here in the US because of the way our media has worked than it actually is in reality. BYD is a company out there that's absolutely kicking butt in China and growing by leaps and bounds. And they're delivering electric vehicles to people. And their strategy with the Dolphin, the BYD Dolphin, which is their vehicle that's designed for a taxi fleet, that's going to introduce more people to their vehicles. That's going to be better for brand awareness than anything else out there when it comes to electric vehicles. So, yeah. Frantic Pillow says, your words and reasoning is the only thing keeping me sane in this market. You've been through market like this before. I've been investing for 2 or 3 years. This is new for me. So I've been investing since like 1996, 97. And I did that with my first like real job where I earned like a real paycheck, where I was working in IT. And so I've been investing for a very long time. And I made pretty much every mistake you can make that's out there. And I talked about my mistakes in a video, a couple of other videos that I made recently. I remember when I first started doing YouTube, and I wonder where this guy is now, but I got made this comment on one of my videos about not taking anything personally. You should have zero emotional investment in a company whatsoever. And we're all guilty of doing this anyway, even though we know we should have zero emotional investment in the company. We're all guilty of this. And I remember this comment that I got where this guy's like, well, it took you 30 years, you stupid boomer, to figure this out investing. And I figured it out after 2 or 3 years. I wonder where that guy is now, because I can tell you that as far as investing goes, basically every plan but the traditional plan of diversification and long-term buy and hold has failed now after that 3-year period or 2-year period since I started my my YouTube channel. So, and the traditional old ways of investing are looking a heck of a lot more attractive right now. What's not looking attractive right now is bonds on the long end of the spectrum. Those have gotten crushed. I think this morning in the industry meeting that I was in, I think bonds on the long end were down like 9% already for the year. They're going to continue to get crushed on the short end. We're probably going to see actually values for bonds on the shorter end start to look more attractive, and yields are going to actually are going to start declining at this point. At this point right now, I think people are starting to price in a recession, price in the fact that a hard landing may be in the cards, but a soft landing being in the cards is probably a little bit less likely than it was yesterday, and a lot less likely than it was like 2 months ago. 2 months ago, I still had the hope that we would have a soft landing for the economy. At this point right now, I think that we're already 6 to 7 months into a bear market. And typically bear markets last anywhere from 9 to 18 months. So yeah, I've been through this a couple of times before. And like I said, I've watched people who are invested in the market, very much involved, lose their shirts and never get back into the market. And I've seen that happen over and over and over. Part of it is I think is where I live, where we see a lot of wealth cycling, where people come into money because of how real estate works here. They take that money, they go out and invest, they make some mistakes, they get burned by the market, they never jump back in. Like, I could probably name a dozen people that I know personally outside of my professional life where that has happened, and at least another dozen people in my professional life where they came into $500,000, $250,000, invested all in stocks, did well for 2 or 3 years. The first time the market takes a dump, sometimes they're not even back to where their original investment was. They just lose like $100,000 and $500,000. They get really upset. They bail out of the market and they never get back in. Or by the time they get back in, it's too late. And it's simply because of the way psychology works when it comes to investing. You get far more pleasure. You get far more pain, rather, out of seeing a 10% decline in your investments than you get pleasure out of seeing a 10% gain in your investments, because you know that it can evaporate, right? You know that it can go away. But it's kind of weird how that works. If I have $500,000 and I make $50,000 on top of that, yes, that makes me happy, but not as upset as watching it go from 500,000 to 450,000. That pain, that minus $50,000 pain, is a lot greater than the pleasure you get from that $50,000 gain. If it goes up, that is one of the things that affects investor psychology more than anything. And if you are in the industry as a financial professional, you study investor psychology a lot. You're taught to manipulate investor psychology a lot. And that is something that I want to avoid on this channel. I want to give you guys sort of sane and sober advice, not personalized, but generalized advice when it comes to investing. Is that right now the sky is not falling. It's actually already been falling for the last 6 months. Okay. And if we are going through a recession, we are going through a bear market, then the pricing started 6 months ago. And you're too late to miss the majority of the pain. You've already experienced it. Okay. Will it get worse? There's a distinct possibility that it's going to get worse. Are we at the bottom today? There's also a distinct possibility that the bottom could be today. No one knows when that is. No one's got a crystal ball. Okay. And this is a phrase that you use over and over and over, that nobody has a crystal ball in the financial world. Even financial professionals are just wrong all the time. And some of the ones that are wrong the most are the perma bears. Like, there was this guy, I can't remember his name now, but I had this one client who was all about investing with this guy, and he was just a perma bear, man. He thought the sky was always falling in, and if you would have invested in his fund in 1980, he had averaged 18% loss from between like 1980 and 2000. So nobody who invested with him in 1980 had any money left at all, essentially. And yet he was still able to command an audience because of how he marketed things, right? Ray Dalio, I think, is in danger of becoming one of those guys. Now, he is interesting in a way that he connects his narrative to history, but he's also a perma bear. Everything about his view of the universe is how the universe is collapsing, and how we are in decline. And so actually, somebody in my Patreon group in Discord made the point today that that Ray Dalio really sees the rest of the world as static, meaning that he looks at Eastern Europe or looks at Asia and thinks that they're not changing over time, that they've remained the same, without realizing that there have been vast changes in the last 10 or 12 years. And that's one of the things that I still try and keep up with. Like, I haven't actually toured through China on my own in 20 years now. I want to go back soon because I recognize that everything has changed since then. And I'd love to go back and see what's going on there. It's just been a little bit harder to travel, of course, since I got married, had kids, and that sort of thing. So, but no, am I going to panic? Absolutely not. Will I end up selling anything? So I didn't sell anything in 2020. Not a thing. Largely because as a student of history, I understood to a large degree the effects of pandemics on markets. Right. In this case, like I said, I had an accidental gain earlier this year, and I wanted to offset some of that with loss. So I am considering selling one of my positions, trying to realize about $30,000 or $40,000 in loss to offset some of that gain. It wasn't in my plan to earn that this year, and I don't want to pay taxes. So, but I want to make it reasonable. I did a whole big spiel a couple of weeks ago on when you sell a stock. My pathological avoidance of taxation. I do have a pathological, I'll do anything legal to avoid paying taxes, which is not always the best thing for an investment portfolio. Okay. So yeah. Michael Will says, not that I partake, but Bitcoin is getting hammered today. Isn't BTC supposed to hedge against market corrections? So no, Michael, it's not a hedge against market corrections. It's not a hedge against inflation. It's really the asset class is in it. Trust me, 2-3 years ago, you could not call this an asset class. It was simply it was simply speculation. Today, I would call it an asset class. But if you only look at the last 2 years or so, it looks like it's somewhat correlated to the stock market, and it's not functioning the way people thought it would. People thought it would function as a hedge against the stock market or as a hedge against inflation. There's actually no evidence that it will function like that. So at least not now, while it's still relatively immature. This is a risk-on asset, and when people want to de-risk their portfolios, they're going to get rid of Bitcoin. And if right now, though, if I was in a country like Ukraine or Russia and I wanted to leave, I'd be really happy about Bitcoin declining in value at this point if I'm taking local currency and converting that into Bitcoin and getting ready to go try for political asylum somewhere else. Like I said, in the long run, I think we're going to see hundreds of billions of Russian dollars migrate here to the West in the form of cryptocurrency. I think that's going to happen. So let me see here. Whoops. Let me see here. Daniel Winnick says, in my opinion, if you're not a professional investor, you put your money in the market for your time horizon, your chances are much better. Actually, that's true. And the 5-year number there is not arbitrary. There's some research that's based on that. In any one single year, you essentially have a 20% chance of loss, right? By the time you get out to 5 years, I mean, it's talking about in any particular stock, random stock, like you take Post-it notes, stick it on a wall with all the stocks on the S&P 500, take a handful of darts, toss that handful of darts at the wall, and you invest in the stocks that the dart goes through, right? Or the handful of darts goes through. You basically have a roughly equal chance of loss, but you have about a 20% loss with each one of those stocks, but a 20% loss in that portfolio in any given year. By the time you get out to 5 years, that drops to like a 6% chance of loss. So if you have a well-balanced portfolio and a time horizon of 5 years, you have a 94% chance of making money over that 5-year period, a 94% chance in any 5-year rolling period, any 5-year rolling period. I think the minimum to have was 15 stocks, and it needs to be diversified across, of course, across industry type. The problem with most people listening to me right now is that we all probably are a little bit too heavily weighted in technology stocks. So between my ETF portfolio, which is about 70% of my holdings, and in my individual stocks, I probably have about 35 to 40% of my overall portfolio through the ETFs or through my individual stock choices invested in technology in one form or another. Now that may be fintechs, which are getting crushed right now, or maybe technology like Tesla at this point, which I kind of mentally excluded Tesla because it actually they're a little bit over my allocation right now. I'm going to be forced to sell a few shares of that by the end of the year. I want to wait for the split. And let's talk about the split, by the way. That's not on the table. That's a foregone conclusion at this point. If it's going to be on the docket to vote on at the meeting in August, it's a foregone conclusion that it's going to happen. I expect some good amount of price action at some point between now and August. Tesla's a very volatile stock, right? The fact that it's down 20% doesn't mean anything to me because if you up 20% by next week, it can literally happen in a week. The longer you've been invested in Tesla, the longer you realize that. I expect some pretty extreme price action between now and that meeting in August, and then after that meeting in August when they vote on the actual split. Shortly before or immediately after the actual split, then it's probably going to drop at that point. But yeah, price action looks like that's coming, and it looks like it could be fun. So I will probably be disposing of some of my shares in that time period when it hits a target amount for me here. And of course, that's another reason why I want to do some tax loss harvesting now while some things are down, and some stocks that I think don't have as much potential to snap back really quickly. And I'll tell you, I'm probably looking at Unity. I'll still have plenty left in a long-term portfolio, but I'm looking at probably Unity not being able to snap back very quickly. They need to have some really, really good news in order to do that, like some really spectacular news in order to do that. So Nate Robinson says, I'm fully invested now until next payday. Do you believe now is a good time to build up a cash position or stay fully invested? Stay fully invested. Dollar cost average your way in as you get your paydays in. And I can tell you, one of the things that surprised me is I've generated a lot of money this year selling options, covered call options as the market has declined. I've just been steadily buying into some of the position, but steadily buying the boring stuff, like my ETF portfolio. And the snapback is going to be pretty hard when the market does turn around because of how broadly diversified I am right now. And so I would definitely dollar cost average your way into the market. This volatility is not finished. You're gonna have plenty of opportunity to invest in these stocks at lower prices over the next couple of months. We're gonna have more shocks on the way. The Federal Reserve kind of indicated that they're going to do like 7 more. There's a possibility that they could do 7 more interest raises by the end of the year. The market doesn't seem to think that that's true. It hasn't priced that in at this point, but if they really do 7 more raises this year at a quarter point each time, then yeah, don't fight the Fed. That's one of the basic axioms of the basic self-evident truths of investing is don't fight the Fed. In this case, I wouldn't fight the Fed. I would definitely dollar cost average your way in. I think making big moves right now, you run the biggest risk of making a mistake if you're already fully invested. If you're not fully invested and you have, by luck, by whatever it is, a giant cash position right now, yeah, I think right now would be a good time to go out and look to bargain hunt right now. So Pat Mulligan says bio is getting crushed for the last few months. Yeah. So the window on biotech and on particularly in genomics was always longer than I wanted to admit to myself, right? So it's really a decade away before we really see the type of returns that I want to see in order for this to be a great type of investment. And so I've talked about this before. Like in genomics and in biotech, I tend not to do individual stocks, and I tend to use ETFs to do that. And I use a couple of different ETFs, and ARKG is one of them. And it's because as much as I'm a fan of genomics and I'm a fan of genetics, and I actually worked in a field at one point where at least we discussed genetics all the time, and we discussed things like genetic drift and evolution. We discussed things like heritable trait, all that stuff. I'm not a geneticist, and I'm just an interested amateur nerd, and I don't believe that I will ever have the expertise to look at a stock's, look at what the press is saying about a technology, and look at what their company fundamentals are, and say this is a great technology to invest in. I don't think I'm ever going to have that expertise because I'm not a scientist in that field. So I prefer to do that through an ETF where you get some quality control there and you get some diversification. So I will definitely be picking up some ARKG here in the future. So but an ARKK. So I will not be picking up ARKK just because of the high concentration in Tesla. I've already got plenty of Tesla. If you can't buy Tesla shares outright, ARKK is a way to get good exposure to that, as well as to a bunch of other technology stocks that are on sale right now. Compared to November of 2021, basically the NASDAQ is down almost 60% at this point. So Steve-O says, SOFI is getting scary. SOFI's not getting scary. SOFI is already scary. Okay. But look at the last video I made on SOFI. SOFI is a growth story. Okay. They're still looking at growing their revenues at this point. The more that I investigate into this company, the more I realize that Galileo has gotten their hooks into a lot of different companies as well, in terms of being the underlying backbone, fintech backbone for those companies. Their business is just going to grow. I think you're going to see growth in banking operations, of course, as that banking charter comes online. You're going to see growth in their technology platform, and you're going to see growth in their financial services platform as well, apart from lending. And lending, especially student lending, of course, is no longer, in terms of the origination of new business. When they updated their numbers for the rest of the year, they predicted about $100 million decline in revenue. So about from 1.57 billion down to 1.47 billion for their full year guidance. That's not a tremendous decline when you say, hey, they're like, we're basically going to get no new student loans for the rest of the year, right? They're looking at that huge reduction. So that tells you that their revenue sources have rapidly diversified over the last 2 years, and they're continuing to rapidly diversify. I think that SOFI represents one of the better opportunities that's out there right now. So I want to do a little bit more research on Upstart. Upstart is a company that I've been looking to buy into for a while. I don't have the time or luxury to really do a deep dive on it in a live stream. I just took a look at it earlier, but that's another one I want to take a look at. Lenders tend to actually do well in interest rate environments as they go up. But there is a lag between the beginning of interest rates rising and when they really start to go do well. And it can be anywhere from 12 to 24 months after interest rates start to rise, because you see that giant spread between deposit operations and loan operations. So yeah. So my shopping list with this market correction, actually my shopping list is probably quite a bit more boring than yours is. I am looking at here. Let me pull up some of my shopping list here. Like I said, I'm not adding any more Tesla just because I have tons of Tesla. So Upstart is on my shopping list. Nvidia is on my shopping list. I own some Nvidia, not as much as I'd like to. I don't own Upstart yet. It's on my shopping list. Although I'm gonna investigate a little bit more as to why that went down. Morgan Stanley, I've owned a little bit of Morgan Stanley for years. It's definitely on my shopping list at this point. The Goldman Sachs is on my shopping list at this point. Basically, a lot of your big investment banks are on my shopping list because of how financing works. Now, I'm not looking at Wells Fargo for its banking operations. I think that that's probably going to end up suffering for them as we go further down the road. I'm looking at investment banks like Schwab, Morgan Stanley, Goldman Sachs. That's where it goes. People tend to do very well in this environment. Square, my acquisition cost for Square right now is about $100 a share. It started out around 120. I've been able to lower that down to 100. I'm probably buying some more. Pubmatic is actually one of the big things on my list right now. And if you guys don't know who Pubmatic is, they are a company that sells real-time programmatic advertising for internet content creators and advertisers worldwide. They work with a bunch of different companies that you've heard of out there, like all the major apps that are pushing ads to you, and they control all of the feeds and algorithms that you see. So I am that's actually one of the big companies that I'm looking to add right now. And it's down big. Pubmatic is actually down pretty big after market. I bought like 15 shares today of that, and that's just because I had that was just the cash that I had on hand. I'll probably be looking to pick up more shares of Pubmatic as a priority as things turn around. This company is a growth story. You're looking at revenues growing from in 2018 from $100 million to 2019 to 120 and to 2020 to over it's 148 million. And this year they're 226 million and they're profitable, right? With 56 million in earnings. Every quarter for the last 4 quarters, they've beat earnings by a little bit. And so their guidance going forward is they're predicting a little bit less in the way of earnings. And it looks like they're reporting today also on May 9th. I can guess that, and it looks like insiders, bullish Programmatic insiders, filled their treasuries with $9 million worth of stock over last year, meaning that quite a few insiders were buying their own stock when it came to Programmatic. So that's a company that I'm looking at. So the way that e-commerce works here in the US is probably now going to follow some trends that are going on in China. Like traditional e-commerce and finance, there's still plenty of it going on, but there's this new sort of live streamed commerce that's going on where live streamers are going out to like giant parking lots and selling cars, or they're going out to public squares and selling things in China, and they're everywhere with their phones and their streaming devices. And this is the way they're marketing things now. I don't think that things are going to happen exactly the same way here as they happen there, but the way that we do e-commerce looks like it's going to be evolving in unexpected ways right now. So you're not just going to go to Amazon and they're going to serve you the products that the Amazon algorithm thinks that you want to see, or things that you bought before. Although Amazon's very good at suggesting things for my boat. So if you guys don't know, I built my own boat starting a few years ago, but I really accelerated during COVID. I literally finished it yesterday. Worked on it yesterday, most of the day, finished wiring in the fish finder and all that. And I get back to my computer, and Amazon is now suggesting finishing touches for my boat. They're suggesting cup holders. And I realized that's one of the most important things on a boat. I didn't plan for it, but the algorithm is smart enough to figure out that while the things that I was buying, it knows that I'm building a boat, right? I never told it that it knows that I'm building a boat, and now it's suggesting all of these finished items for a boat. That's amazing. That's utterly amazing. So that's the kind of thing that Programmatic does, right? Is they work on that algorithm to deliver real-time suggestions to you that you're likely to take action on. And it's a completely AI driven. And that's one of the reasons I like this business going forward. So yeah, Programmatic is going to be one of my big picks. And I think I'm grabbing this right now. I don't know that this is the bottom, but if it drops down to $10 a share, I'm really happy to buy $10 a share. But of course, I would be happier. I think my average cost on this is somewhere right now at around 19. But yeah, let me see here. Yash, and I'm not even going to try and pronounce your last name there, buddy. Thoughts on SOFI in the near term or medium term? So I don't do a ton of talking about the near term or medium term on my channel, but I will do this. Like, nothing is going to look great in the near term. I don't think nothing is going to look great in the medium term. We're not going to see improvements, I think, in terms of volatility before the end of the year. Okay. If you're an investor and you're a serious investor, you're just going to have to get used to this. Just grit your teeth and bear it. There will be times, if you have made good stock picks and you are confident that they have a business that can weather all types of business environments, then a lot of times your best move is to do nothing. Or a lot of times your best move when the stock is down is now it's time to buy. So I bought like 100 shares of SOFI last week at like $6.31 a share or something like that, which is well below my average, right? And so I'm getting crushed on this stock. But I do happen to love their business model and love the way it is a growth story. And watch my last video that I did on SOFI. It was out a couple of weeks ago where I went through financial results. So, well, I guess my wife is feeling better because she has decided to vacuum now. She started vacuuming downstairs. She's been sick for the last week and a half, and I've been taking care of her. Let's see. Pat Mulligan says, I'm very good at doing nothing. Honestly, when you look at the differences between male investors and female investors tend to perform better than males. And there was a lot of there was a lot of research to find out why that was. And the bottom line is that women just tended to do less in an investment portfolio. I don't know if they had less interest. I don't know if they had less confidence. I don't know if they just simply had less desire, or they had a better handle on long-term strategy and were better for planning the future. I don't know if any of those were true, but the reality is that women trade a lot less frequently than men and tend to do better over the long term than men do when it comes to investments. Even though the vast majority of people in the financial industry are men, it's women who are the better investors. And that's been the case for at least 30 or 40 years. I'm not talking about financial professionals. I'm talking about the general public. When these companies do their research on their own clients, they find that women are far better investors than men are. And if you're good at doing nothing, it may mean that you're going to end up being a good investor over the long term. Over the short term, though, it may not feel that way. You always feel like you have to do something. And sometimes that feeling is your worst enemy, right? You're going to make a decision at the wrong point. And I worry about that too. I've been doing this for a very long time. I'm not worried that my account is down like 40% since November. I knew that was going to happen at some point. I have a lot of risk. But I am worried that I make these micro decisions that are end up going to be the wrong decision down the road. But I'm not worried about the overall health of my portfolio. So, and I think a lot of you folks probably aren't either, if you're getting your information from a variety of sources, not just me, but I wouldn't necessarily be listening to anyone that makes you feel excited about anything. Okay. That is not what you should feel right now. I don't want to lie to you guys. It's going to be painful for the next couple of months. And your best strategy, I think, is to hold the line when it comes to investing, to dollar cost average your way into your best long-term positions. I would avoid the temptation to try and turn a quick profit on anything. And I would start looking, really, I think the investments you make today, and I've said this before, the investments you make today for your long-term picks, your extremely long-term picks, like your 5, 10, 15-year picks, the investments you make today are the ones that are going to make you rich. And I'm not talking about the get rich quick today thing. I'm talking about, it's going to be a grind. You're going to get rich slowly, but it's going to happen with your investments, today and over the next 6 to 9 months. Investing now is, I mean, it's another one of the things that's paradoxical about human emotions, is that when the market's doing well, that's when you want to buy more. When the market's doing poorly, that's when no one wants to touch it. When the reality is, now is the time you should start thinking about investing and thinking about dollar cost averaging your way in. So yeah, let's talk about anything else, guys. I'm fully available here to answer any questions that you might have. And Keith X, let's look here. I am hoping everything would go down to zero so I can buy them for free. Yeah, that's the dream, isn't it? That's the dream. So Moneyline was one of those companies, and I haven't looked at it since I made the video, but Moneyline was one of those companies I'm looking at where I'm like, well, it's basically almost zero. It's maybe time to take a speculative risk. But it was about $2.17 cents a share. Now it's $1.45, and I'm just looking at it right now. $1.45 a share for Moneyline. Would have been a speculative risk. Would have been something that I would hope to turn a short-term profit on that. That would not have happened in this case. And it's a risk-on asset, guys. It's a very risky asset. But a lot of companies similar, a lot of fintech similar, like OppFi is down to $2.95 a share. Dave Inc. is down to $2.64 a share. Kazoo Group is $1.19. Actually, I don't know what Porch Group is, but Kubian is down to, wow. Okay, so Payo is down to $3.95 a share. Okay, yeah. So there's a lot of companies that have just gotten absolutely hammered right now. Depending on how patient you are and how brave you are, there could be quite a bit of opportunity here in fintech. And I've been saying this for weeks, that I think that the avoidance of fintech is probably one of the greater misallocations of capital going on right now. Is that you're going to see quite a number of these fintech companies do just fine over the next 1.5 to 2 years in terms of growing their business. They're just positioned correctly to take advantage of basically any crisis at this point, and their income streams are rapidly diversifying. So I'm thinking you're going to see a lot of opportunity there. So Electric Last Mile Solutions, down to 72 cents a share. Let's see what is the 52. What's the maximum on this? So Electric Last Mile Solutions down from January of 2021, $13 a share, down to 72 cents today. Absolutely getting crushed. Hyzon Motors, down to $3.28 per share. It looks like they were at roughly $12 a share. Was it $12 a share? Whoops, hold on. My charts are kind of messing up here. Anyway, absolutely getting crushed. Lots of other people are getting crushed in this market. Tons of opportunity out there. Michael Will says, have you updated your thoughts on Russia and Ukraine? So Updated my thoughts in what way? That are only so I tend not to get involved in politics unless it affects the economy. My thoughts on Ukraine right now is it's just absolutely effing up supply chains worldwide, and it's going to continue to do so, and it's going to cause an oil price shock, and it's going to further exacerbate inflation. I fully expect to see oil at over $150 a barrel by the end of summer. I don't. I think it's going to happen. Oil supply could increase dramatically, and it might actually. Like OPEC might start pumping more. We might start buying more from Venezuela, and it could increase dramatically. And because of options trading, we're probably going to see a big increase in the price of oil. That's simply going to happen. So my thoughts on the actual war itself, it's going to last for a long time. Ukraine's military, while they're doing really well in a defensive war right now, they are not set up they're not set up to project power into another country. Their military is not formed that way. It's territorial defense is how they're designed. They don't have the industrial or capacity to do that. So Russia, on the other hand, they've got enormous industrial capacity that's unused. That's not very good. It's unused, but they've always had this attitude that quantity is a quality all on its own. I think it was Lenin that may have said that, or Stalin, one of those guys. But yeah, so I think that this is going to go on a lot longer than we think. I'm hoping today, because I listened to Putin's speech today. Putin's speech was not what everyone thought it was going to be. It wasn't an announcement of full mobilization. It wasn't an announcement of escalation of any sort. And it kind of looked like he may be looking for a way out, maybe looking for a way to say, okay, we've achieved victory. We accomplished all of our objectives. Now we're going home. And we won, which definitely isn't the case either. Ukraine just has to not lose. But the problem is, though, is this is not going to be, even if they lose and go home today, the economic problems caused by this aren't over. There's going to be sanctions on Russia until Vladimir Putin is gone. They could replace him with another oligarch who's just as bad, and I think we would probably lift sanctions on that. But it's actually, once there is some sort of regime change in Russia, it's in our best interest to extend the olive branch and make friends, right? Just like we did with Germany, just like we did with Japan. And we need to do a better job of supporting institutions in Russia that are going to lend itself to be a more open society. Like, I think it's a shame that you look at societies in Eastern Europe like Poland and the Czech Republic and Romania, and these are countries that ostensibly had the possibility to backslide into authoritarianism. You look at Hungary, and it is backsliding into authoritarianism as well, or a little bit. But these countries have the potential to do that, but they're fully integrated into European economy now. They're fully integrated into Western trade, and that's really worked out because that olive branch was extended to them, and they got financial assistance to do that. And we extended that olive branch at the end of the collapse of the Soviet Union, but we didn't provide them enough. I don't think we provided them enough financial support to do that. And the lives of the average Russian was not improved by the fall of the Soviet Union, whereas the lives of the average Romanian, lives of the average Czech citizen or Slovak citizen or Polish citizen was actually greatly improved by the fall of communism. So, yeah, I think we need to do things differently this time around after they collapse. And I am thinking that Russia's economy is going to collapse relatively quickly. They're looking at 12% reduction in GDP for the year. I think that's radically overly optimistic. They're looking at a much greater decline in GDP. And this is, remind you, this is a country where male life expectancy is really low compared to the Western world. Most people that live outside of major cities don't have indoor plumbing. They're horribly underdeveloped in terms of roadways, rail lines, that sort of thing. They haven't made a ton of economic progress in the last decade or so. The single year of 12% decline in GDP will wipe out more than a decade's worth of economic growth for Russia, more than a decade's worth. So, yeah, I think that we are. It's going to be years before certain things in the supply chain are worked out, and in the immediate term, the United States, with its massive amounts of arable land and the ability to produce fertilizer, we need to start growing more things to export, more food products to export to replace what parts of Russia and Ukraine are not going to be able to produce this year because of the war. So, yeah. And Keith X says, I thought I was diversified, but apparently not. Why is it? Why doesn't so many of, okay, so you didn't, why do all the chart patterns look the same? So that's not entirely your fault. The idea of diversification has changed, Keith, over the last 3 decades or so. So all asset classes are more closely correlated than they were 30 years ago. There's a number of theories behind why this is the case. I think it's because there are far more non-professional investors involved. Even though there's there are fewer humans involved in your most active end of the trading, the media surrounding the stock market is controlled now, not necessarily by people in financial media, but a lot of it is controlled by Reddit. A lot of it is controlled by news groups. A lot of it is controlled by comments on Yahoo News articles or whatever it is, or on Barron's News articles. And I think that is changing the way asset classes are correlated. It used to be that long-term bonds and stocks were relatively perfectly uncorrelated, meaning that as stocks decline, long-term bonds went up. That is not necessarily the case. They are still not correlated, but they are much more closely correlated than they were in the past. One of my favorite asset classes in the past, junk bonds. Now they're called high yield bonds, but to me, they're still junk bonds. That was one of my favorite asset classes in the past because it wasn't tightly correlated to stocks. It wasn't tightly correlated to bonds. It kind of did its own thing. In today's environment, it's actually pretty highly correlated to the S&P 500, which I don't like anymore. So now that's an asset class for me that has kind of fallen out of favor. I do like right now a couple of different closed-end funds with convertible securities. I think that is a really interesting bet right now for an inflationary environment where your worst case scenario on those convertible securities, as long as you have enough credit quality control and diversification, your worst case scenario is probably a positive return of some sort. It may not be much, but it's still a positive return. And your upside on that, because those bonds are convertible into a predetermined number of shares, your upside on that is pretty good, meaning that you could convert those into shares. And if you don't know anything about convertibles securities, during my last live stream, I went into a long diatribe on convertibles. You can find it. It's like after the first 36 minutes. I went into a long diatribe about inflation and then a couple of things you could do about inflation. But yeah, Keith, that's not your fault, man. The training that you get, the things that you read, a lot of time it's based on research that's 35, 40, 50 years old. And we are looking at a few things that have changed now. And the fact that all asset classes are now more tightly correlated than they were before, I think is a function of how our media is delivered to us now. It's not, it's not, they shouldn't be correlated. So let me see here. Pat Mulligan says, I think Disney is very interesting at this level. Actually, I'm a huge fan of Disney as an investment because of the properties that they own. It doesn't matter really what you think about the Mandalorian or what you think about what they've done to the Marvel cinematic universe. They know how to exploit those titles for money, and they're doing a very, very good job of that, and they're making lots and lots of money. So their earnings per share right now is a buck is 1.68 per share. Their PDE ratio is 63.57. They seem a little bit expensive right now, but for Disney, it's not out of the ordinary for them. They've been over that for more than a decade now. They've been pretty highly priced. But even at the $107 a share, when I look at the properties that they own, and I look at so when we go through tough economic times, people get nostalgic. And Disney is one of those things that everybody has nostalgia for one Disney property or another. And if we go through an economic downturn, I'm going to bet that you see actual Disney subscription for their streaming services grow because of that nostalgia factor. Even though people will pick and choose what they can afford and what they can't afford, and a lot of people are going to choose to drop Netflix or choose to drop, what's the one that Star Trek is on? Is that CBS? Whatever. They're going to choose to drop a few other properties, and they're going to end up going with Disney because of that nostalgia factor. But so let me see here. And then I got a question here that I don't really understand. So I got a question here. Is like, what do you think about Upstart? It's 43% after hours overreaction. So I'm not on the call. I think that call is going on right now. Mr. Seba there. And it was down like 26% when I looked at it. It was 43% after hours. And the very quick release that I saw on that for first quarter earnings, things look pretty good, but they didn't give any forward guidance in that release. I'm going to bet that in that call that their forward guidance looked pretty bad. But a lot of companies are doing that right now. And you're going to see this a lot with financial companies is they're preloading bad news right now. And they're probably reducing their forward guidance now more than it's actually going to go down so they can outperform here in the future, right? So they're going to outperform expectations in the next couple of quarters, but they're just preparing that business is not going to be as good as it was last year. It doesn't mean that Upstart is crashing or going away. Although I said I do have concerns about the credit quality of their portfolio. We see here, and for some reason the software that I'm using today is really slow with getting the comments up. It says, hey Jason, what's your largest single stock position at cost? I'm not sure what you mean by cost. My largest single stock position is Tesla though. And that's not based on how much I spent on it. It's just based on how much it grew. And so I've had a couple of cases in my life where I bought a lot of something for very little. Those was Hanson Natural Products, which is now Monster Energy Drink. Literally, a girl dumped me, and I had a bar soda, or not bar soda, but a Hanson Natural Product soda on the beach. Thought it was a great product. Found out how to invest in the stock. This would have been like 1996 or 97, and bought like 1,000 shares or something like that at like less. I think it was $1.50 a share or something like that. And years later, it pays for the down payment on my house essentially. So, and then Asta Funding was another one of those where I bought for very little. That company I don't even believe is publicly traded anymore, but I made something like 6,000% on that. Tesla is another one of those where I spent substantially more on that, but my first 100 shares was $3,300, right? And my next 100 shares cost me significantly more, but it's the largest portion of my portfolio because of the astronomical growth, not because I took an early chance when that early chance would have cost me very little. So that is my largest position. And Nathan W said, or no, here Leo Wu says, I'm still all in on Xpeng. So I'm not all in on Xpeng, but I still have about 1,000 shares or so of Xpeng. I haven't sold any since from my original position. It's one of those right now where I was going to buy a bunch more at around $44 per share, and I'm glad that I did not. And the only reason that I didn't is because something came up and I had to spend the money on one of the businesses that I own instead. And so I'm kind of happy that I didn't do that. But at the levels right now, I'm probably going to try and add another 1,000 shares. And like I said, this is another company that I have. As long as they don't get delisted, I think that they're set up really well for long-term growth. And I think that Xpeng's floor would probably be around $15 a share, and $15 a share sometime in the next 6 to 9 months or so. I think that's probably their floor. So I'm happy to pick them up at 20. They were $20 a share the last time I looked. What are they now? Let's see what they are right now. You see, Xpeng was at $20 a share. After hours, they're at $19.79. Happy to own it at that price. Do I think it might decline further? I do think that it might decline further. I do think that one of the things that should be obvious right now is that Xpeng's path towards manufacturing superiority over Neo right now looks pretty definite. Okay. Neo should have had their biggest facility up and running, producing its first cars based on the original timeline. That should have been done by the 1st of April. It's still not done at this point. I don't know that that's going to happen. And they're not saying anything about when that's going to happen either. So, so I would average down if you could now. My average on that is I'm actually below
my cost on that as well. So I'm down on that as well at this point. I'm still up pretty far on Neo, but I'm down some on Xpeng at this point. I think my average cost was something like $28 a share on that. So I'm down on that as well. Look, the pain's just gonna last for the next 6 to 9 months. The only thing you can do about it is bail now, but then you run the giant risk of not getting in at a better price and owning fewer shares when the market does turn around, right? That is the only thing you can do. You can't control the price of Xpeng. You can't control the past and when you purchased it. You can use covered calls to generate a little more income on that stock. And like generally, when I sell covered calls on a stock, I usually use the premium on there to buy something else and not that stock. Because think about it, you're selling a cover call on a stock, you're actually taking a bearish position on that. If you turn around and buy more of that same stock, and I realize this is sort of mental accounting, it doesn't make a ton of sense in those cases, but I tend to take that premium and buy safer assets, like in my longer term portfolio. But that's one of the things you could do as well. And I can tell you that is one of the things that's really, really cushioned, especially since the beginning of the year. I probably generated an extra 8 or 10% just on covered calls that expired worthless. And that has really cushioned my portfolio, and I bought safer assets with that at this point. So so anyway, guys, it has been about an hour and a half. Great live stream. I had a lot more people on it this time than I did last time. So really happy that happened. Thank you very much for attending. And thank you very much for all your questions. And I'm going to do this more regularly. I'm probably going to do this again next Monday. I look forward to seeing you guys. And it looks like I'm going to be a little bit less busy this week, so I can put out some more videos. And thank you very much. And I'll see you next time.